Welcome to Deep Dive into Finance Channel, where we unravel the mysteries of the financial world. Today, we're going to shed light on a term that is often thrown around in the world of startups and venture capital, but may seem elusive to some: the seed round. To put it simply, a seed round is the first significant round of business financing by private equity investors or venture capitalists. In the life cycle of a startup, this stage is the ground zero. The term seed suggests exactly what it is: the initial capital needed to start growing an idea into a fully fledged business. This phase of financing is critical for many reasons. For starters, it provides the necessary financial resources to cover initial operating expenses and to move from a mere idea to a tangible product or service. Think about it like planting a seed in a fertile ground and providing it with all the necessary nutrients to grow. Furthermore, a successful seed round can also pave the way for future rounds of funding. It's like a domino effect. Once the seed round is secured, it sends a positive signal to other potential investors that the startup has some traction and is worth considering. But it's important to remember that seed round isn't just about the money. Sure, the capital is important to get things off the ground, but it's also about the connections, the network, the strategic guidance that comes with the investment. These intangibles can be just as valuable, if not more so, than the financial investment itself. In a nutshell, seed round is the make or break moment for many startups. It's the first big test of a startup's potential, the first opportunity to prove to investors and the market that it's worth betting on. It's the first step towards turning a vision into reality. Now that we have a basic understanding of what a seed round is, let's delve deeper into its intricacies. In the world of seed funding, there are several key players that come into play. Let's meet these players, shall we? First up, we have the angel investors. These are individuals who have a high net worth and are willing to invest their personal funds into a startup in its early stages. They're called angels for a reason. They swoop in when a company is just starting out, providing the much-needed capital to help the business take flight. In return, they often ask for an ownership stake in the company, allowing them to share in its future success. Next, we have venture capitalists or VCs. These are firms that invest in startups and early-stage companies that have the potential for high growth. Unlike angel investors who use their personal funds, VCs invest other people's money, from wealthy individuals to large corporations. They're like the big league players in the startup investment world, often coming in after the angel investors in later funding rounds. They, too, seek an ownership stake in the company with the hope of a substantial return on their investment. And then we have crowdfunding platforms. These are online platforms that allow a large number of people to invest small amounts of money into a startup or project. It's like a virtual gathering of people who believe in a business idea and want to see it succeed. This type of funding has gained popularity in recent years, thanks to the rise of platforms like Kickstarter and Indiegogo. Each of these players brings something unique to the table. Angel investors bring their personal wealth and often their industry expertise. Venture capitalists bring a larger pool of funds and a wide network of business contacts. Crowdfunding platforms bring the power of the crowd, a large number of people willing to invest in a good idea. Understanding the players in the seed round helps in comprehending the dynamics of this early-stage financing. It's like a game of chess, each player with their own strategy, their own strengths, all working towards that ultimate goal, helping a startup grow from a seed into a thriving, successful company. Securing seed round funding is not a walk in the park. It involves a meticulous process. It's like embarking on a journey where the destination is as important as the trail you blaze. So let's get started and map out this journey together. The first step in the process is preparation. This is where you, as an entrepreneur, put together a solid business plan and assemble a promising team. Your business plan is your roadmap. It outlines your business concept, market analysis, marketing strategy, financial projections, and operational structure. It should be compelling enough to convince investors that your business idea is worth their money. Your team, on the other hand, is your vehicle. It's the force that will drive your business forward. Investors want to see a team that is skilled, dedicated, and capable of overcoming the challenges that lie ahead. Once you're prepared, the next step is pitching. This is your chance to present your business plan and team to potential investors. The goal here is to create a compelling narrative that highlights the potential of your business and the capabilities of your team. It's about selling not just your idea, but also your vision. Following the pitch comes negotiation. This is where terms of the investment are hashed out. It is a delicate dance between the entrepreneur and the investor, with both parties seeking a deal that benefits them. It's crucial to remember during these negotiations that while the aim is to secure funding, it's equally important to maintain a healthy balance of control over your startup. Finally, once terms are agreed upon, the funding is secured. The investor provides the agreed-upon capital in exchange for equity in the startup. This capital is then used to fuel growth and take the business to the next stage. Though the process may seem daunting, a well-prepared startup can successfully navigate through it. It's about planning, persuading, negotiating, and finally, securing that much-needed capital to sow the seeds for future growth. Like any other investment, seed round financing comes with its own set of risks and rewards. It's a thrilling ride where fortunes can be made or lost. Let's delve in. From the investor's perspective, the risks are high. When you're investing in a seed round, you're essentially placing a bet on a startup that likely has little more than a business plan and a dream. These nascent companies often have no proven track record, no revenue, and sometimes not even a product. That's a lot of uncertainty. Moreover, startups face a myriad of challenges in their early stages, including market competition, regulatory hurdles, and the ever-looming threat of running out of cash. Yet the potential rewards can be enticing. If the startup succeeds, early investors may reap a significant return on their investment. Picture the early backers of companies like Uber or Airbnb. Their initial investments, once seen as risky, transformed into fortunes when these companies took off. On the flip side, for startups, seed round financing can be a lifeline. It provides the capital they need to develop their product, hire talent, and get their business off the ground. However, there's a catch. In exchange for this capital, startups often have to give away a portion of their equity. This means they're essentially selling a piece of their future potential earnings. And if the startup doesn't perform well, it could end up being a costly trade. The seed round can also set the tone for future funding rounds. A successful seed round can generate buzz and attract more investors. Conversely, a failed seed round can be a red flag, deterring potential investors and making it harder for the startup to secure future funding. In summary, seed round financing is a high-stakes game of risk and reward. It's not for the faint of heart, but for those who dare to take the plunge, the payoff can be substantial. Despite the risks, the potential rewards of a successful seed round are significant. Let's take a moment to recap what we've learned about seed round financing. In our journey today, we've explored the concept of seed round financing, a crucial stage in the life of a startup. It's the initial capital raised by a company, much like a farmer planting the first seeds in a field. It's a pivotal point that can set the tone for a company's future growth and success. We've met the key players involved in seed round financing. They include the startups seeking funding, the angel investors who provide the initial capital, and venture capitalists who may step in for larger investments. Each player has a specific role and contributes to the overall dynamics of the process. Speaking of the process, we dove into the nitty-gritty of how seed round financing works. It starts with a startup presenting its business idea and potential to investors. If the investors see potential, they provide the necessary capital in exchange for equity in the company. This exchange is not just about money, it's about trust, belief in the idea, and the potential for growth. But as with any investment, seed round financing comes with its own set of risks and rewards. The risk lies in the fact that startups are, by their nature, unproven entities. There's always the chance that the business might not take off as expected. On the flip side, the rewards can be substantial if the company does well. Investors could see a significant return on their investment, and the startup gets the funds it needs to get off the ground and potentially become a major player in its industry. In essence, seed round financing is a fascinating blend of trust, potential, risk, and reward. It's a critical step in a startup's journey and a moment that can shape the trajectory of emerging industries. Now, you are better equipped to understand the dynamics of seed round financing. Thank you for joining us on this deep dive into finance, and we look forward to seeing you in our next video.